Good evening, and thanks for joining me again tonight on another Fireside Chat. The stock market has had a significant rally of recent, and a lot of people are asking me, do I think this is the bottom, and is this the rally? And the short answer is, of course, that I don't know. It certainly, I believe, the economic recovery is just been it's going to take a long time, and the depth of the 30 million or so unemployed is certainly going to be quite devastating and take time to work itself through. That doesn't mean, however, that the stock market isn't going to start to look forward, and as it looks forward, we could very well see that we've had this sharper V-shaped recovery, and maybe this is the beginning. Although I think we'll have some sideways moves for quite some time, though, as we work through this over the next year or two and work our way out. Of course, the big question right now, recently, that I've been getting to is on oil. What's going on with the oil market, and especially with the negative price for oil that we had a week or so ago. And what's happening with oil, of course, is the classic economics 101 that you'll remember from your classes, and that the supply has just been way too much for demand, which has been just destroyed. There's nobody driving right now. There's nobody taking trips on aircraft. Nobody's staying and traveling to hotels. And because of that, the demand for oil has just dropped precipitously. And then you couple that with the price war that went on between Russia and Saudi Arabia at a horrifically untimely time, and that certainly caused the oil prices to fall further. Now, as futures contracts come due, that causes some additional volatility, because what's happening is unlike farmers, so our southern clients much better understand futures contracts than a lot of Wall Street traders, because they own the underlying commodity. So if you farm tobacco or wheat and you want to hedge your risk, you can buy the future price of that contract, but you own the underlying asset, so you're not going to get too burned. But when you just buy a futures contract and don't own the underlying asset, you could get very hurt by that price swing higher or lower. And when that contract comes due, that's when you have to come up with the price, and a lot of times people don't have it. And that's why effectively you have prices going negative, because you have to pay somebody just to get the oil off of your hands. Now, oil, of course, isn't worthless. People have kidded about putting it in their pools if they had one, just to back up the oil. And there's certainly some opportunities to be found. Now, back when I used to purchase our commodities, I would do it through structured notes. Interest rates were a lot higher back then. So what I would do is look for a note that would have precious metals in it, industrial metals, agriculture, and energy positions. And I would use the 5 or 6% yielding treasuries, and we would call the investment banks and ask them for this basket that we were looking for, and they'd say, okay, we give you this much participation, and we'll have a floor on it, or you can't have natural gas in it because that's too volatile, or we'll give you X amount of participation rate. And the nice thing about structured notes in that sense is that it's a derivative, and it would move with the price of those underlying commodities, and it would be a good way for us to hedge the risk of those underlying securities, and of course move with inflation, because most commodities are going to move with inflation over time, kind of like I was talking about in the gold video I sent out recently, where I talked about gold mirroring the price of a man's suit over 100 years. And the nice thing about structured notes is they're backed by the financial institutions. So during the financial crisis, if those banks went under, there was a lot of risk, and that's why the Federal Reserve and the federal government got involved in backing the banking system, because there was an abject collapse going on at that time. But it was a good way for us to at least use the interest to purchase those commodities. Well, now interest rates are so low, there's just no reason for us to own those structured notes. And it was one of those times when, frankly, just got lucky, because we had doubled our money in most of the positions that we had, because oil had gone well over $100 a barrel. Interestingly, one of my neighbors here from Summit, New Jersey, as a former Goldman Sachs analyst, was calling for $200 a barrel of oil, and I write about this in my book. And I felt that was abjectly ridiculous at the time. And in the summer of 08, we sold out of all those positions. And of course, we know what happened as we moved into the financial crisis and energy prices collapsed down with demand going down at the time. Now this time, what I had done in 2017 was move out of all of our U.S. Energy positions, and that included ConocoPhillips, Marathon Oil, Transocean, Ensco, which is now Valaris, Chevron, and Exxon. And then subsequently sold also our international positions, which included British Petroleum, Eni, the Italian oil company, Royal Dutch Shell, Sasol, Equinor, and Total, French oil company, earlier this year, because I believed that oil was going to be range bound to $50 to $60 a barrel. And with other pressures from alternative energy sources, I felt it wasn't an asset class we really wanted to hold. I didn't mind lending money to companies that we owned on the debt side. Of course, when we had this collapse at that point, we sold a great majority of our bond energy positions, although we still hold about a 2.5% position. And just recently, because oil is so distressed, I feel that a long-term position in ExxonMobil, which is, in my opinion, the strongest balance sheet of all energy companies across the globe that are publicly traded, with maybe Saudi Arabia's Aramco could make an argument for that one also. But I'd rather own ExxonMobil, and the dividend yield, of course, is quite attractive, and I hope it holds up for our clients. So with that, that's what's going on with energy. So there's a lot of, some clients are asking, is this a great time for us to be investing in energy with prices this low? And the answer is possibly, but I think we want to be cautious. I think energy prices will eventually recover, but I think it'll take some time. And so we're going to stay underweight the asset class for quite a while, and most of the securities, I would imagine. Of course, we're finding plenty of opportunities in other sectors, that you've seen in healthcare and others. And I think these kind of companies and consumer staples and consumer discretionary will participate as we get back to work. And I've mentioned in past videos that there's a lot of debate. Elon Musk came out today and said this is fascism that's going on, that we have to let people get back to work. And there's certainly one model is the Swedish model, which we've seen, where we have social distancing and letting herd immunity eventually happen, and keeping the elder population safe, especially those who have higher risk factors. And then there's the other side of the argument where you have the most totalitarian, like the Chinese method, which is just, take away all rights, make sure everybody's safe, have high tracking, arrest people who are not quarantined, and that could work too, possibly. The reality of it is that we're not going to know for quite some time which method was best. Even when you look at the Swedes, they've certainly had more deaths than their neighbors in Norway or Finland. But over longer periods of time, they may actually have less. We'll just have to see. So I think that when you look on one news network, which will say, constantly all the negative about one way or another, and vice versa, another network which is proposing that the other side is wrong, we don't know yet. And we're going to go in fits and starts. But I do know one thing, that America's going to recover. If you look at the Spanish flu, we eventually got back to work. And it's going to be interesting to see, as some states get back quicker than others, how they do. Some of us, I know in my family, I'm quite certain my daughter had it, and probably most of us have had it here in New Jersey. Her two best friends were actually positive for the coronavirus, and it's a virulent virus, and it's going to spread around. Fortunately, it's not as deadly as we originally thought, though. And secondly, the antibodies are showing that a good part of New York City residents have gotten it, quite possibly like our family, and maybe more that we don't even know of, where people are asymptomatic. So that's the good news, and I think the good news right now, we've had essentially this fear be overcome by the fear of missing out, and you're seeing the market rally. And I think we're positioned to continue to participate in market rallies as we've had, but also prudently be able to collect our income and wait and patiently wait for prices to eventually to recover. As always, if you have any questions, don't hesitate to call me or your senior client advisor with any questions. We appreciate the trust that you put in us. It's something it's continual for us and working. You can see tonight it's midnight almost, and I'm working. So I'm here for you, and don't hesitate to call if you have or email with any questions. Thank you.